Managing an investment bank process, the Warren Fox Group. Course breakdown. Class 1, winning client mandates. Class 2, deal launch preparation. And Class 3, go to market. Winning client mandates. Class breakdown. During this class, the Warren Fox Group will cover the below topics. Lesson 1, internal operations of an investment bank. Lesson 2, pitching potential clients. Lesson 3, getting staffed on a pitch. And Lesson 4, engaging potential clients. Managing an investment banking process. This is Lesson 1 of Class 1. In this lesson, we will review investment banking business operations and the associated complexities and risks embedded in the industry's revenue model. Background. Every practitioner begins their journey in investment banking with an interview, and during the interview process, candidates will constantly be asked, why investment banking? The candidate needs to understand the industry before he or she can make a genuine determination on why investment banking. The Warren Fox Group believes that one of the best ways to understand a business is to understand the business's revenue cycle. In this section, Managing an Investment Banking Process, the Warren Fox Group will provide candidates and young professionals with a candid view of the day-to-day operations needed to execute and close capital markets mandates, from deal origination to deal preparation to deal execution. Sports analogy. Think about it this way. The stated goal of most professional football teams is to win games, whereas the goal of an investment bank is to close deals. The football team doesn't begin the season when it takes the field in game 1. Rather, the football team employs hundreds of players, coaches, and managers and support staff to execute upon their goal on a year-round basis. The season begins months before the first kickoff. The team prepares by having its players engage in practice, having its coaches conduct film reviewing and game planning, and having its managers develop strategy, all in hopes of winning games throughout the season. The same goes for investment banks. Banks do not begin the mandate by pitching the investors. Instead, many resources and months of hard work are necessary to win client mandates, prepare clients for market, and to ultimately close deals. The goal of this course is to highlight the core components of what it takes for investment banks to successfully close deals, or in other words, win games. Revenue cycle of an investment bank. A revenue cycle, or a revenue funnel, is how a business makes money, from the beginning of services to the end of the collection process. Sometimes the best way to understand a business is to understand its revenue cycle, and an easy way to think about revenue cycle is who pays who, what, and when. The revenue cycle of an investment bank is unique due to its complexity and its overall length. The revenue cycle of an investment bank can take months, if not years, to fully complete because of the way banks are paid. The lion's share of the bank's revenue is realized when the client's mandate is executed or when the deal is closed. Simply just engaging a client and winning the mandate could take months alone, not even counting the deal's preparation and execution. Beginning of the sales motion. Deal origination. The sales motion begins with deal origination, which is the act of winning client mandates and developing new business. The goal of deal origination is to build the bank's pipeline and ensure constant deal flow. Deal flow is a number of client mandates that the bank is currently in market with. To maintain a healthy business, the bank needs to maintain deal flow. This helps explain why networking is a vital skill set in investment banking. The bake-off process. Deal origination usually culminates with a successful bake-off. The bake-off is essentially a tryout. The client offers an opportunity to a select group of bankers to showcase their service offerings. Inbound mandates and client vetting. Sometimes client mandates originate from inbound interest, which usually spawns from the bank's networking efforts. Banks must vet the client to ensure that the mandate can be traded in the marketplace. If the mandate cannot trade, then the bank should not engage, because ultimately it won't be paid. Executing a client mandate. Deal execution is a massive undertaking that requires deal preparation, going to market, negotiating and closing a deal. Concluding the revenue cycle. Investment banks provide capital markets advisory and receive fees for their services. There are many types of fees an investment bank can receive, but the largest fee by far is always the success fee. Therefore, the revenue cycle does not conclude until the deal has closed and the transaction has been funded. This highlights the vast distance between the beginning and the end of the investment banking revenue cycle. Risks of the investment banking revenue cycle. Not only is the revenue cycle long, it is also risky. The bank puts forth massive amounts of resources, time, and effort to build relationships and manage processes, but it is only rewarded if the bank can close a deal. For example, if outside factors such as market conditions change when negotiating a deal, the buyer could simply walk away and the deal dies. The client is out of luck and the bank is not paid. Thank you for tuning into this lesson, and we look forward to seeing you at the next one, in which we will be discussing pitching potential clients.